Hello viewer, thank you so much for joining us for business studies. We are going to look at the source documents and books of original entry. Get to us with any query through our SMS number 22518. Our Facebook page is Erimo TV, or you can also get to us through our Twitter handle Erimo_KE, and let's run together. Ask us any question, and for more running, go ahead and like our Facebook page, and you'll keep on updating more that you need to know. So today, being our lesson 9, we shall be looking at the journal. Remember, we are still on source documents and books of original entry. We've looked so far at a number of journals, how you're supposed to prepare them, and then what you're supposed to do after you prepare them. We do what we call posting to the various ledgers that we have already discussed. So today we shall be looking at the journal, but not before we review our last lesson. During our last lesson, we studied the analysis cash book. I showed you how you are supposed to prepare the analysis cash book. Then after that, I left you with some assignment where you are supposed to prepare an analysis cash book. So from the question that I had given you, this is how your analysis cash book was supposed to appear. As you can see, you have the date column, you have the particulars column, you have the total column. Then on that side, you're supposed to have all the columns involving revenues. You are supposed to have all columns involving revenues. Then on the other side, you also have the date, particulars, the total column, and then all the columns that involve expenses. So that's what you are supposed to note. And as you can see, on the 2nd of December, you have revenues that is in form of donation, 10,000. So you include that amount under the total column. Then you don't forget to put that amount under the column of donation, as you can see. So we are recording the amount twice. First under the total column, then under that particular column, the column for that particular revenue. As you can see, we've recorded 10,000 under the total column, then under the donations column. Still on that 2nd, you had an expense that was postage. 300 was used on postage. As you can see, still under the total column, you have 300. Then under the postage column, you also record the same. So you do that for each and every revenue and expense that you have. Then after that, we get the total, and you can see the totals, all the totals on the revenue side. You have 18,000. Then on the expense side, you have 3,800. So we want to balance it by getting the balance brought down, and the balance brought down is got by taking the totals of the revenues, you subtract the totals of the expenses. So to get this 14,200, what we have done is that we've taken 18,000, you've subtracted 3,800, and that is how we are getting 14,200. And as you can see, both sides balance, and their balancing amount is 18,000. So that's what you are supposed to do, and I want to believe that that's what you did. And if not, rectify where you went wrong. The most important thing to note in this case is that we subdivide the analysis cash book into two. On one side, we have the revenues, as you can see, that is on the left hand side. Then on the right hand side, you have the expenses, and remember, you are preparing the expense, the column for each expense. So we cannot say that we have this exact number of columns. No, the number of columns, as we said earlier on, is determined by the number of transactions that the business has. and also the need of the business. So whatever that we've been given, only be in a position to either classify it either as a revenue or an expense, and you follow the procedure as you've seen what we've been doing. Then after preparing the analysis cash book, you are supposed to post. You are supposed to do the posting to the ledger accounts. So let's look at what you are supposed to do. We start on the accounts that involve revenue, and you can see on the revenue side we have the donations. So you prepare the donations account. So this one is supposed to be posted to the donations account, and you can see we are taking the total for donations. The total for donations is 12,000, and you can see the date is at the end of that particular month. At the end of that particular month. So you can see under the details column, you say totals from analysis cash book. Totals from the analysis cash book, and the total amount is 12,000. We are crediting. Why? Remember, I told you that an increase in revenue is credited, while a decrease in revenue is debited. So that is why we are crediting the donations account. And for all the accounts involving a revenue, they are going to be debited. Like if we look at the next one, the subscriptions account, it is also debited. It is also credited. It is also credited with 5,000, and that is the totals from the analysis cash book. That is the totals from the analysis cash book. Then the other one from the revenue, we have the miscellaneous receipts. So, and the miscellaneous receipts were adding up to 1,000 shillings. They were adding up to 1,000 shillings. So you can see the details. That is the totals from the analysis cash book, and we are crediting because it's a revenue. Then we go ahead on the other ledgers accounts that you're supposed to prepare. We have the postage account. Postage account, remember it was on the expense side, and the totals for postage was 300. We are debiting. The reason why we are debiting is because an increase in expense is debited, a decrease in expense is credited. So don't wonder why we are debiting this account. We are debiting because it is an expense. The other account you're supposed to prepare was the traveling account. Traveling account, so it was also an expense. So you're supposed to debit that that account with 1,000 shillings, as you can see. That's what you're supposed to do. Then you also had the stationery account. The stationery account, the total for the stationery was 500. So that's why we are debiting this account with 500 shillings. And finally, we have the rent and rates account. Rent and rates account. And the total for rent and rates was adding up to 2,000. So that's why we are debiting that account with 2,000. And that marks the end of our last assignment. I want to believe that you did so. Where you went wrong, kindly rectify. Maybe before we proceed, I want to emphasize on something. We are talking of posting to the ledger accounts. To be exact, you find that the accounts that we have prepared involves revenues and expense. So these two accounts are usually contained in the nominal account. So if you said posting to the nominal account, well and good. So I'm saying that if we have the various types of ledgers. Now I'm talking about revenue and expenses. Revenue and expenses are usually found in the nominal ledger. They are found in the nominal ledger. So if maybe you said posting to the nominal ledger, well and good. Let's now look at the objectives for our today's lesson. I said that we shall be looking at the general ledger. The general ledger is also called the journal proper. So by the end of the lesson, the learner should be able to explain what is the general ledger, and 2, you should be in a position to prepare the general ledger. So let's start by looking into details. What is the general ledger? I'm saying that the general ledger is also referred to as the journal proper. So the general journal records transactions which cannot be recorded in the subsidiary books of accounts already discussed. Remember, we started with the sales journal, purchases journal, and we looked at a number of them. Now that we've already looked at that, you find that in some cases, there are some transactions that cannot fit in the general journal. And therefore, what happens is that if a transaction cannot fit to be recorded in any of the journals we've already discussed so far, they are recorded in what we are calling the general journal. The general journal is also referred to as the journal proper. So such transactions are recorded in this journal before posting, or before they are posted to the ledgers. And you find that the general journal usually shows the accounts to be debited as well as the accounts to be credited. Not only that, when you are preparing the general journal, you have to make what we call narration. We narrate the transaction. And you'll find the reason why we do the narration is because the general journal contains transactions that are not similar. The general journal contains transactions that are not similar, and therefore that is why I'm saying that it's very important to do what we are calling narration. Narration, you just describe in a few words. You describe the transaction in a few words. And I'm saying narration is important because the general journal contains transactions that are not similar. Why are we saying that they are not similar? When you look at the examples, you'll come to find that. So if you are to look like the sales journal, you did the sales journal earlier on, you'll find that the sales journal records all transactions involving sale of goods on credit, sale of the stock on credit. So they all find that all the transactions are actually very similar. The transaction for the sales that are recorded in the sales journal, they are similar because they are involving selling of stock on credit. So if you make any sales on credit, just note that that is recorded in the sales journal. Now when it comes to the general journal, what are those transactions that are recorded in the general journal? So we look at now the examples of transactions that are recorded in the general journal, and they include: 1, purchase of a fixed asset on credit. I want to believe that you know what is a fixed asset. And a fixed asset is an asset that has been that is purchased by the business to be involved or to help in the production of goods. The other one is the sale of a fixed asset on credit. We also have what we call opening entries. We also have closing entries and other transfers. We also have correction of errors. Back then we'll be talking. We've already talked, or maybe you've also already come across what we call errors that involve that affects the trial balance, errors that does not affect the trial balance. So such errors. We also have writing of bad debts. This is whereby you do away with the debts that have taken too long before they are paid. So when you are writing off bad debts, in any transaction involving writing off of bad debts is recorded in the journal. And the other transaction that is recorded in the journal is the issue of shares and debentures by companies. So what we are going to do, we are going to look at each and every transaction we've already mentioned in details. Then after that, remember, what are we preparing out of such a transaction? We are preparing the journal. Now, let's start with the one that is the sale of a fixed asset on credit. Sale of a fixed asset on credit. And once again, I've said that fixed assets are bought and to be used in business, in production of goods. So they are not bought for resale. They are bought or to facilitate the production of goods and services for sale. Now, what happens is that fixed assets bought and used in business, they slowly loses their value. That is through wear and tear, a process we refer to as depreciation. Now, when they get old and they turn out, what happens is that such an asset can be sold to someone else, maybe who may be interested. So, if such an asset is sold on credit, that transaction is recorded in what we are calling the journal. I'm saying if such an asset that is already old and is no longer useful for the company or for the business, if such asset is sold on credit, that transaction is recorded in the journal. You may have maybe a lorry that was being used for transportation of goods to various destinations. You may also have a machine that was used maybe in production of goods. So such assets are the ones that we are referring to. At some point, they depreciate or they lose their value. And that is when they get to be sold to a different party. So if they are sold on credit, the transaction that is done is recorded in the journal. Now, how do we prepare the journal? I want us now to look at an example. Then we prepare the journal. The following transactions took place in the business of share traders during the month of May 2016. On May 5, we have an old lorry worth 80,000. It was sold to Nairobi traders on credit. So out of this transaction, you can come up with two accounts. The lorry account, and also they have the Nairobi traders account. The lorry is our asset. Nairobi traders are our debtors. On May 15, we have office furniture worth 120,000, which was sold to Mombasa merchants, remember, on credit. Now, what are we supposed to do? That's how we are supposed to prepare the journal. It has around 5 columns. You have the date column, that is the date when the transaction took place. You have the particulars column, whereby we have the 2 accounts. Then you also have a small description, a little bit of a description involving the transaction. You also have the folio column, the debit, and the credit. Like now, for the first one, we have old lorry worth 80,000 being sold to Nairobi traders on credit. So Nairobi traders are our debtors. And remember what are our debtors? Debtors are assets. And how do we treat assets? An increase in asset is debited and a decrease in asset is credited. So what we are going to do, remember, in every transaction there is always an account to be debited and an account to be credited. So when you are preparing the journal, we have the Nairobi traders account. So that one we are going to debit because Nairobi traders are debtors. So that's why we are debiting the Nairobi traders account with 80,000. The Rory account, remember Rory was our asset. An asset is also a decrease in asset is credit, and that is why the Rory account we are crediting it with 80,000, which is the same amount. Then after that you are supposed to describe the transaction. So that's why we are saying being the sale of an old Rory on credit to Nairobi traders. Our next transaction was on May 15, and we are being told that office furniture worth 120,000 was sold to Mombasa merchants on credit. Still on this case, Mombasa merchants are our debtors. Also, and that is why we are debiting Mombasa merchants account by 120,000, and office furniture we credit that with the same amount, that is 120,000. Followed by a small description, being the sale of office furniture on credit to Mombasa merchants. Being the sale of office furniture on credit to Mombasa merchants. So that is how we prepare the journal. And there are a number of things that I want you to note. One, if you are keen enough, look at that journal we've just prepared, and you'll find that the account to be debited is recorded first. So you can see in the first case we have Nairobi traders, we also have the Rory. So the reason why we are starting with the Nairobi traders account is because that account is the one that is supposed to be debited. So note that the account to be debited is recorded first, and then the account to be credited follows. The account to be credited follows. The other thing you're supposed to notice is that the account to be credited is slightly indented inwards for distinction purposes. And as you can see, Nairobi traders and the Rory account, they are not along the same line. You can see that the Rory account is the one that is supposed to be credited is indented inwards. And also you can see that the narration given after every transaction is written in the particulars column since they are part of the details. Kindly note that. So that is how we prepare the journal, and we have prepared for this particular transaction, that is the sale of a fixed asset on credit. That marks the end of our lesson. Thank you for watching, and you'll continue to learn more. So I'm going to review with some assignment here. The following transactions took place in the business of Young Achievers Enterprise during the month of November 2015. November 7, sold an old office machine to Town Printers on credit for 6,000. November 23rd, a machine whose book value was 110,000 was sold to Wakulima Traders for 90,000 on credit. So what you're supposed to do in this case to prepare the journal. Let's look at our accounting theme for today. Accounting rules give financial institutions flexibility about when they choose to recognize venture capital profits. Think about that. Thank you for watching. Let's meet during our next lesson. Continue to watch and learn.